My topic for today is depreciation, and my group members are Leone Perfi, Rochelle Cornejo, Ramza Tun, Mary Kenya, and Carrie Scott. To start off, what is depreciation? Well, a simple definition for depreciation is it is an accounting method used to allocate the cost of a tangible or a physical asset over its useful life.
So, since we know what depreciation is, what are some causes that cause depreciation? So, I will be providing you with four causes of depreciation. The first one being physical deterioration. And physical deterioration is a cause that comes in two forms. The first form being wear and tear. It's where assets that are used eventually wears out. And these consist of vehicle, machinery, and buildings that last very long and the others only a few years. The next form is erosion, rust, and decay. This is where Mother Nature is doing her own work. The metals of the vehicle and machinery will rust, the woods from the buildings will rot, and other equipment will decay if it is without any type of proper attention. The second cause is the economic factor. This is when a business puts down assets that are in good condition because of the two main factors being obsolescence, where society is being advanced and technology is being advanced, or other type of progresses. The other factor is indequency. This is where the business is the one that grows, and therefore there will be a need for the business to upgrade from a smaller equipment or assets to bigger equipment. The third cause of depreciation is the time factor. Time alone can cause some assets to lose their value. If they are not used at all, tangible fixed assets like lease, patents, copyrights, and etc. eventually lose their ability to function. Last but not least, the fourth cause of depreciation is depletion. When resources are extracted from certain assets, such as coal mines, metal, and oil reserves, their usefulness and values are diminished. The basis for changing depletion is the amount consumed by the relevant
In
asset.
depreciation, we use two methods. One of the methods that we use in depreciation is the straight line method. This method spreads the cost of asset evenly over its useful life. An example of this is a car was bought for 50,000. The business decided to keep it for 10 years and then sell it for an estimation of 5,000. The formula for the straight line method is as follows: asset cost minus salvage value divided by useful life. For the example above, the asset cost is 50,000 and the salvage value is 5,000. The useful life is 10 years. So in order for us to solve, we would take the 50,000 minus the 5,000 divided by the 10 years, which would then give us 5,000 divided by 10, which would then give us our final answer, which is 4,500. In reduce, we also have another method which is called the reducing balance method. This method applies a constant rate of depreciation to the declining book value of the asset each year. An example of this is a machine bought for 40,000 has an estimated life for 6 years. It is to depreciate at 20% using the reducing balance method and calculate the charge of depreciation in the third year. The formula for reducing balance method is as follows. Book value at beginning of year times depreciation rate. For the example above, the depreciation year 1 would be as follows. 40,000 times 20%, which would then give us 8,000. We would then take that 8,000, we then take 40,000 and minus 8,000 from it, which would then give us 32,000. In depreciation year 2, we take the 32,000 times 20%, which would then give us 6,000. We would then minus 6,000 from 32,000, which would then give us 25,600. In the depreciation year 3, we would take the 25,600 times 20%, which would then give us 5,120. We would then minus 5,120 from the 25,600, which would then give us our final answer, which is 20,480. Some terms to know when it comes to depreciation. Cost of asset. The cost of asset is the purchase price plus any expense required to get the asset ready for use. The salvage value is the estimated residual value of an asset at the end of its useful life. The book value is the asset's value at the start of the year. We already know two of the methods used to calculate depreciation, which is the straight line method, which the formula for that is the cost of asset minus the salvage value divided by the useful life. And we also know the reducing balance method, which the formula for that is book value at beginning of year times depreciation rate. But another method we can use to calculate depreciation is the total expected units of the production cost of asset minus salvage value times units produced during period.
Why is depreciation an expense? Depreciation is an expense because it reflects the allocation of the cost of a tangible asset over its useful life. Here are some reasons why. The matching principle means that as an asset is used to produce revenue, its cost is gradually recognized as an expense, reflecting the wear and tear or reduction in value over time. The asset value reduction. In this, depreciation accounts for the decline in value of an asset due to factors like usage, age, and outdated. By recognizing depreciation, companies provide a more accurate picture of their financial health. Financial reporting. By including depreciation in financial statements, this will help stakeholders understand how much of a company's assets are being consumed over time, giving a clearer view of financial performance and asset management. Cash flow impact. This states that although depreciation is a non cash expense, it reduces taxable income, leading to lower tax liabilities and enhancing cash flow. This preserved cash can be reinvested in projects, asset maintenance, or operational needs, ultimately improving the company's financial stability and flexibility over the long run. Overall, depreciation as an expense ensures a more accurate representation of a company's financial position and performance.
We know what depreciation is now. Let's use this information and try to understand it using a real life example. So here we have Zenith's workout space. Zenith's workout space has the fixed assets, the cost, the estimated useful life, the salvage, or the residual value. The fixed assets for Zenith's workout space is machines. The cost of machines is 15,000. The estimated useful life is 10 years. The salvage or the residual value 2,250. The other fixed asset is the building. The cost of the building is 750,000. The estimated useful life is 50 years. The salvage/residual value is 150,000. The fixed asset is furniture. The cost is 15,000. The estimated useful life 5 years. The salvage/residual value 750. Fixed asset land. The cost is 70,000. Estimated useful life is 1 year. The salvage/residual value 70,000. The last fixed assets for Zenith workout space is fixture. The cost is 60,000. The estimated useful life is 3 years. The salvage or the residual value is 4,200.
Machines, building, and land will be depreciated using the straight line method because we thought that they had a predictable degradation which highlights the expected decline in the asset's condition over time, and we also thought that they had a longer useful life. Furniture and fixtures could be depreciated using the reducing balance method since they depreciated rapidly in value, reflecting their usage and changing trends more accurately. Then we decided to conduct research on a company in the same industry as ours so we could get more information, which leads us to the Belize Chamber of Commerce and Industry Organization. We found that their fixed assets were as follows: straight up building, office furniture, fixtures, equipment, and vehicles. They used the straight line method to calculate their depreciation. Then we decided to use the reduced balance method to calculate the depreciation. We then chose our building to start off and calculate depreciation for 5 years. For example, if the building costs $750,000 and the depreciation rate is 2%, the annual depreciation expense would be $15,000 in the first year. The depreciation expense is $15,000, in which the net book value of will be $735,000 after subtracting the depreciation. In the second year, the depreciation expense is again 2% of the remaining book value, which calculates to $14,700. This reduces the book value to $720,300. We had chosen the reducing balance method because of two reasons. Tax implication. This method allows for accelerated depreciation resulting in higher expenses in the early years. This lowers taxable income, providing a tax advantage and enhancing cash flow for reinvestment. Then industry standards. The reducing balance method aligns with common practices in fitness industry, accurately reflecting the rapid depreciation of gym facilities and equipment due to wear and tear, ensuring consistency in financial reporting. Some factors that we discovered had been taken into consideration when choosing a depreciation method were type of asset, useful life, tax implication, financial reporting requirements, and industry standards.
Please make sure to like and subscribe to our YouTube channel, and make sure to leave a comment down below on your thoughts on depreciation, and please check out our YouTube channel to see more depreciation videos. Lastly, have a nice day. Peace out.